Hey, what's up, stock compounders? Brad here. So, Mohnish Pabrai has just released a talk he did for London Business School. Okay, and as always, I'm going to share my highlights from that Q&A session with Mohnish Pabrai at LBS. So he starts off. He usually gives a monologue, and then he gets into the Q&A. So this time for the monologue, he talked about Domino's and Pizza Hut. Okay. And he talked about how, maybe 20, 25 years ago, Domino's and Pizza Hut were both dine-in establishments, okay? But over the last couple of decades, they've gone through radical changes where, whereas a couple decades ago, it was all dine-in, now it's virtually all delivery and carry out, okay? So it's gone through a radical change over the last few decades. You wonder why Pabrai is thinking about Domino's? Well, every 3 months, Mohnish Pabrai has an orgasmic experience, okay? He reads through these 13F filings of, all of the best investors in the world, at least in the US. And of course, he saw Domino's on Bill Ackman's 13F, okay? Now, it's not the first time Pabrai has looked at Domino's or talked about Domino's. There was a talk, I think it was at Boston College in like 2016, where Pabrai talked about how Domino's, he puts Domino's in the bucket of a great business that requires great management, okay? So the highest kind of level bucket for Pabrai is great businesses that an idiot can run. Okay, there aren't many businesses like that. I think Visa, MasterCard, Moody's, Coca-Cola, there are very few businesses that an idiot can run and they still do great. So Domino's was kind of on that second tier where you still need a great management team to run it. If you guys want to dive more into Domino's, Young Hamilton has a blog and did a pretty excellent write-up on Domino's. It's quite thorough. So I'm going to link to that in the description. Check that out if you want to dig deeper into Domino's. So we're getting into the Q&A. Pabrai was asked, how important is it to have business experience as an investor, to have experience as an entrepreneur? And Pabrai, I love this quote. He said, "You can talk to a fish about walking on land for 100 years, and it won't even come close to the experience of walking on land for 5 minutes." And really what he's getting at there is people who have run businesses in the past have a huge advantage in investing, okay? They have that experiential understanding of what it takes to run a business, which just makes it so much easier to break down, different business models and investment opportunities. So, really important. And he talks about how almost no entrepreneurs run their businesses through spreadsheets. But of course, that's how the majority of investors seem to analyze investment opportunities is, by plugging a bunch of numbers into a spreadsheet, for example, a discounted cash flow valuation. So it really doesn't quite do justice, I think, what it takes to really make good investments. And he talks about how entrepreneurs focus on 3 to 4 variables that will move the needle for the business. Okay, it's not about this complex spreadsheet. It's about the couple of things that matter. And I had this experience. I managed a moving company in Madison, Wisconsin. I also managed the 1-800-GOT-JUNK location in Madison. And, there were really only a few metrics that we would focus on. One was NPS, Net Promoter Score. How satisfied are customers with our service? That's what the NPS score was designed to tell us. How many jobs did we book each day, total for that month? And, how long was each average job? There really weren't that many metrics to track. So, that's the key. That's the key to investing. Figuring out what are those couple things for the business that you're analyzing, and just focus on those. Track those over time and make sure the business is getting better. He talks about the human brain. I'm not going to get too much into that. The only thing I'm going to say about that is Pabrai thinks it's really important between kind of the ages of 11 and 20 to specialize. Okay. That's, Buffett. It's no accident that Buffett bought his first stock at 11 years old. I'm pretty sure that's right. 11 years. It was within a couple of years of 11 years old. And that's really when the brain wants to specialize, and it's most kind of fertile and open to taking in all of that information that really can allow one to specialize, to deep dive into a subject. Bill Gates, was really immersed in computers early on in his teens. So gave him a huge edge when it came to building the juggernaut that is Microsoft. And, Pabrai says, of course, in modern schooling, right, schooling in the US, what we do is we force people to generalize, right, to learn all of these different subjects between the ages of, basically when we get to school through, at least through the end of high school, but also through college in large part. And that's really a disservice to finding our craft, to really becoming good at something. So that really resonates, I think. We need a lot of reform in our education system. So he was asked about starting a fund. He says, if you're looking to start a fund, you should already be wealthy, okay? You need to prove to yourself that you know what you're doing in investing. And if you know what you're doing, it really doesn't take that long to become independently wealthy. So, a lot of people ask Pabrai, how do I start a fund? It's not the thing most people want to hear, that you should already be wealthy before you start managing other people's money. Because most people think, well, I can get rich if I can just manage other people's money and charge these fees, right? I'm really going to juice the compound growth engine if I can take advantage of OPM. And that's true, but, Pabrai took a very different approach to it in that, he didn't need the money when he started investing, right? He had built a business. It's like a $20 million business or something. Started with $1 million because I think he sold some part of the business. And, it was really just a game that he set out to turn that $1 million into $1 billion over 30 years. And, between 1995 and 1999, he had already turned that million into like 13 million in 4 years before he started his fund. So it's not a commonly tread path to, start a fund similar to Pabrai's, where you don't charge any fees for breathing, right? You just charge a performance fee with that hurdle that Pabrai uses, which is 6%. So, but of course, having that structure has really set him apart. It's gave him a huge moat in the investment management industry. It talks about inner scorecard. This came out of the lunch that Pabrai and Guy Spear had with Warren Buffett in 2007. The question is, would you rather be the best lover in the world but be known as the worst, or be the worst lover in the world and be known as the best? So it's a great question designed to get you to really understand, are you operating by an inner scorecard where you don't really care what other people think, you're doing it for you, or are you operating according to an outer scorecard And, playing by the outer scorecard, it is not a recipe for a happy life. It's, critical to shift that framework to playing by an inner scorecard, to deciding what is it that I want to accomplish, what is it that I want to achieve, what kind of life do I want to live, and standing by that, regardless of what other people think. He talks about management. Be careful interacting with management. Management got to where they are because they're very charismatic, right? They're very good at sales. They're good at building rapport with people. They're very likable. They tend to be, in the head of sororities or fraternities, playing on team sports, tend to be the head of the football team, maybe the quarterback, things like that. So they got to where they are because they're great salespeople and they know so much more about the business than you do. Okay? So that's not the equation you want when you're trying to rationally, measure a business, when you're trying to decide, all right, should I invest in this business or not? You don't want to be talking to someone who's already deeply invested in that business, has these killer sales skills, and knows everything about the business. Okay, that's not a recipe for success. So what Pabrai does is he looks at the track record. Okay, he doesn't ask them what their track record is. He reads the annual reports, say over the last 10 years, what did they say that they were going to do? And then what actually materialized? And, if something materialized that didn't measure up to what the CEO promised, how did the CEO justify it? Did they make excuses, or did they own up to falling short or making mistakes? You can really gauge the integrity of management by looking at the history of what they've done and how they responded to how things unfolded. And Buffett said, I guess, in the Berkshire Hathaway meeting in 2021, one of the greatest risk factors for businesses is that you end up with an incompetent CEO. Okay, and again, it's really hard to gauge, a competent CEO from an incompetent CEO just by talking to them. That's why it's really important to look at that track record. So Pabrai was asked about GrafTec, which was a previous holding. So he was free to talk about that because he doesn't own it anymore. He said, if GrafTec today came across my radar, I would have a lot less interest in the business than I had at the time that I made the investment. Okay, which indicates to me, GrafTec, it's a discounted pie. Pabrai even says that it was a pretty mathematical investment, right? The numbers were there. What he was seeing is, based on the contracts that were already in place, the company was going to earn back what it costs to buy in about 5 years. So, that's a pretty compelling payback time. And, discounted pie is really, I think, what Pabrai saw in GrafTec. And more recently, obviously, he's shifted over to the growing pies framework, right? He's looking for 100 baggers. So GrafTec just doesn't quite fit that anymore. When the pandemic hit, right, Pabrai was concerned that these contracts wouldn't hold up. The businesses that were under contract could deem a force majeure event and void them. Okay, that's what Pabrai was concerned about. The story changed, right? The pandemic caused the story to change. GrafTec became a lot more uncertain as the world was shutting down, right? Not only could these contracts be voided legally, potentially, but the demand for steel was dropping as the world was shutting down. So, you've got those two factors that, did not paint a rosy picture for GrafTec, and Pabrai did not want to be watching that movie unfold in March of 2020. So he exited at a slight profit, okay? I think his investment had doubled. It had shrunk down to just over break even, and that's when he got out. He would have been willing to exit at a loss, okay? Because again, he just didn't want to see this movie play out. He would do the same thing again, given the same circumstances, in terms of selling when he sold. Okay, so he doesn't think he made any kind of mistake there, even though the price today is significantly higher than when he got out last March 2020. Makes sense. He would do the same thing. He talked a little bit about, the noise around the prospect of Brookfield taking GrafTec private. Okay, there's a lot of talk about that. He was asked, did that factor into your decision to sell? And essentially, what I like, what Pabrai said about this. He said, I don't overdose on conspiracy theories. And there's a lot of people who like to do that. You will live a very happy life if you tone down that everything is a conspiracy against you. And I like that, especially in the realm of investing. People are always looking for, these conspiracy theories that are going to, take their stock down to zero. And, the vast majority of those things just don't play out. And investors spend a lot of time worrying about these, events that really have very little probability of actually unfolding that way. So that's part of the irrationality that investors have to cope with, this kind of paranoia that, things are going to come out of left field and take you out. He was asked, this was a very bold question, by the way. I'd love to hear you rationalize your recent investment in Alibaba. Okay, point blank, he was asked that. Pabrai said, I will duck the Alibaba question, but he didn't actually duck the Alibaba. I mean, he didn't talk too much about Alibaba, but he did give quite a juicy nugget here. He goes on to say, if you have me back in a few years and we don't own Alibaba, although we may own Alibaba for a while, so he kind of backpedals on the few years. When we don't own it, I'd be very happy to talk about it, right? Just like GrafTec. At this point, we're still adding to our position, okay? And you notice in the video, I'm going to link to Pabrai's full talk, there's kind of a break before he says that. We're adding to our position. So I don't know what he cut out there. Only the people at London Business School know kind of, what was chopped out. But he says he's still adding to the position, all right? So, it's already a significant position in Pabrai funds. I think it's like something like 9% or so of Pabrai funds. So it'll be interesting to see what it's at come the next 13F filing. He says, I must like it because we're still buying it. I think it's a business worth studying. That's what Pabrai says about Alibaba. He's asked about position sizing. And here he references Charlie Munger. 4 diverse stocks, carefully selected, is all you need, right? That's diverse enough. The key here is carefully selected, right? You have to know what you're doing. There's probably not that many people who can intelligently invest in only 4 stocks in a way that's, safe. But clearly Charlie Munger is in that camp. If you don't know what you're doing, please index, right? So don't buy 20 or 30 stocks if you don't know what you're doing. Buy the whole market, right? Buy the S&P 500. If you know what you're doing, it seems like insanity to own 30 stocks or even 20 stocks. And the idea here is why pull money away from your first, second, or third best idea to invest in your 20th or 30th best idea? It just doesn't make a lot of sense from Pabrai's perspective. In investing, this was interesting. In investing, we never swing for the fences. Okay, he was talking about Dakshana Foundation and how in philanthropy you want to swing for the fences. Okay, because you're tackling such difficult problems And if you try to, tackle multiple problems, you're just not going to get anywhere. So swing for the fences in philanthropy, but in investing, we never swing for the fences. And how I interpret that, he says, we want to hit these single runs, right? How I interpret that is we really want to pay close attention to the downside. We want to buy with a margin of safety. We want to make sure, heads I win, tails I don't lose much, and really emphasizing the tails I don't lose much. So that's, to me, what he means by we never swing for the fences in investing. Okay, last page, guys. We are almost wrapped up here. This is going to be quick. So he's asked about macro factors. Pabrai doesn't really spend time on macro factors. One, he doesn't have any competence in macro factors. He doesn't think he can, have an advantage, get an edge from looking at macro factors. And those factors, for the most part, don't matter. Okay, that's how Pabrai sees it. He was asked about the 10 Commandments. Would they be different now? Because he's switched from buying these discounted pies to buying growing pies. He says the 10 Commandments definitely need some updating. Okay, maybe we need to take it down to 5 commandments. So hopefully we'll see a video out soon with Pabrai on his new 5 commandments of investment management. He says the purpose of the 10 Commandments was to make it easier for people to live a good life. Okay, so the Cliff Notes version of the Bible, that's the 10 Commandments. It's, very distilled down. Then someone told God, listen, man, 10 Commandments, it's too much. Can you just give me 1 commandment? Okay, I just want 1. And God says, yes, I can do that. Do unto others as you would have done unto you. Okay, that is the 10 Commandments distilled into 1 lesson. Now, there's a similar thing. I tweeted about this. I think if Pabrai had to distill investing down to 1 commandment, here's what he would say. Buy businesses that you want to own for decades, and then own them for decades. Okay? It's as simple as that. He mentions 3 questions from Nick Sleep, all right? In terms of, you're looking at this investment and you ask yourself these 3 questions to really decide if this company is worth investing in. The first question, what is the destination? Where is this company in 10 years, in 20 years? Is the business getting better? All right, is the moat getting wider? Is the moat getting deeper? Third question, is the valuation reasonable? Okay. Is it not egregious? Now, this is really, my understanding of this is it's not when you're looking to buy, it's when you own a business and you're trying to decide, okay, do I sell this thing? It's around intrinsic value now. If you're trying to decide if you should sell, the question is not, is it at intrinsic value? Okay, the question is it egregiously priced? Okay, if it's egregiously priced, if it's 100x earnings, right? The PE ratio is over 100. Maybe it's egregiously priced. Maybe it's time to sell. But if it's not egregiously priced, forget about the valuation. Okay, the business is getting better. If you know the destination, you're a business owner, right? Treat that investment like you're the business owner. So that's kind of Pabrai's new framework that he downloaded from Nick Sleep. And that's it, guys. That is, those are my highlights from Pabrai's talk at London Business School. Again, I will link to that talk in the description. And let me know what your guys' best highlights were from this Pabrai Q&A. It sounds like we're going to be getting like 2 of these every month, which is awesome. It feels like we're getting one every week. Hopefully that keeps up. So I'm sure I'll see you guys real soon with another Pabrai highlights reel. Until then, I will see you all in the next video. Take care.